Hello, class. Greetings to all of you. And depending on where you are at the moment, a warm greetings. Today we are going to tackle the real cost of inventory. This is a follow-up to our last week part one for Learning Unit 5, where we did a good job with the different inventory system, the two inventory system, as well as the valuation methods, right? So as for this part two, I'm going to keep it simple because it's going to be about two things. And the first thing would be how much we need to order, and the second thing would be when do we need to order it? So I repeat, how much we need to order and when we need to order it. All right. So these will be the two things. I'm just going to try to keep it as simple as possible so that you can take great joy of covering it together with me, in your uh, textbook, as well as with all the material that have been provided to you. So please ensure that you understand. And should you have any questions, please feel free to forward this to me. And when it comes to the real cost of inventory, um, there there is two things that are very important, and I've written them down for you on the screen. As you can see, I've written them down. And the first thing would be we cannot base the price on the purchasing cost only. And this is dangerous practice, by the way. And that's what actually your textbook say. It's not me actually who's saying that. So it is very dangerous to base your price. So when you are looking at basing your price, you can't use the purchasing cost only. The second thing, you need to take into account additional cost before agreeing or negotiating price. So these are two important things, and I think it's a no-brainer. And that's the reason why I have put it plain and simple for you to understand, right? So when we talk actually about the inventory cost, what are we talking about? Inventory costs are the cost incurred for the acquisition, storage, as well as the administration of say there are three things there: the acquisition, storage, as well as the administration of. All right. So all these things are parts of what we call inventory costs. All right. We need to take into account all of these things. So acquisition, I repeat, storage, as well as administration of stock. And as we delve deep, you would come to see that the acquisition would have to do with the ordering, which is going to be a very important concept when we touch on the economic ordering quantity, the EOQ, and you will just see it very soon, right? So just bear that in mind, that acquisition, you can look at it as ordering cost. Storage, you can look at it as carrying or holding cost. and the administration of costs, which is very important. So you have about three things that are very fundamental when it comes to inventory cost, right? But when we're dealing with trading inventories, right? So we are maybe talking about a business, a retail business that buys from a supplier and sells to customers, to the general public. When you are talking about trading inventory cost, some of those costs will be obviously your purchasing cost, right? So when you're looking at the purchasing cost, you are looking at the cost of goods. We've touched on the cost of goods, very important um, accounting, or let's say accounting concept or accounts. So you have your cost of goods, um, and it is the cost of goods that you acquire from your suppliers, and this will include, your freight, carriage, railage, basically any means of transportation. Get the goods onto the shelf, ready for sale. Right? Very easy. It's making it easy, and you have some notes there, right? And we have also to look at ordering cost. And I just previously mentioned the ordering cost. But the ordering cost is what we can view as the acquisition, right? So it's not just the acquisition, it's not just the cost, it includes basically the preparing, issuing, and the paying the purchase orders for receiving and even inspecting the items included on the order, right? So there are multiple things there. So if we have to break down the cost in itself and the purpose of each cost, you can see that there are multiple things that are covered within what we call ordering cost, or the fact of, you know, the idea of inventory acquisition, right? All right. Purchase approval, for example. Purchase approval cost and processing cost are also parts of ordering cost. So purchase approval costs as well as processing costs are also parts of ordering costs. So what is the purpose of me, making sure that, we cover all these elements is to make you understand that, you know, behind the term of ordering cost englobes more than just the fact that you are ordering, right? It englobes multiple factors, right? Or multiple um, things. So, and these are very important to conceptualize and to understand, right? Stock out cost obviously would be those will be costs that are incurred by the company when the company runs out of a particular item for which it is in high demand. Obviously, there will be serious repercussions when an item runs out and that item is in high demand, right? Right. So you would definitely have um, expediting costs. In order, for example, to remedy such a situation, let's say a company runs out of a particular item that is in high demand. Obviously, you will incur other costs, the cost of expediting the order from suppliers, right? That will be cost that you're going to need to incur, right? The transportation cost, the opportunity cost, right? So there is missed opportunity there, right? And also loss, obviously, in future sales, right? The reputation of the company could be very much damaged, right? So you need also to think about all that, right? So when we talk about quality cost, what are we talking about? These are costs that are incurred at different stages of the production cycle, right? And depend largely on when a fault in production is discovered, right? So there is a particular standard that the company needs to keep, right? A benchmark, specific benchmark. And when there is failure to meet that standard, it's a quality cost, right? And these costs have dire effect on the operational efficiency of the firm, right? There are four of them. You have prevention costs. These will be costs to prevent the production of inferior quality product, for example. Another cost will be appraisal costs, right? This will be incurred to ensure that the product meets the quality standards, right? So an example of that will be, for example, quality audits. You see in many companies, they have quality audit and inspection cost, right? You have internal failure costs, and that's pretty much, understandable, right? And that could result in lost production, scrapping of raw materials, repairs, because there is internal failure cost, but there could also be external failure cost, which will be incurred when inferior products are delivered to customers. So you understand when it comes to cost, there's quite a lot to unpack, but that's the reason why you just need to have a good read and understands when we're referring, for example, to the ordering cost, what are we talking about, right? When we talk about quality cost, what are we talking about, right? So you it's not only the purchasing cost, right? So inventory, don't look at inventory cost as just purchasing cost. It's more than that. Like we said, inventory cost covers inventory cost cover it englobe the acquisition, the storage, as well as the administration of stock, right? So now that we understand a little bit about what is happening with regards to costs, inventory costs, now we can go into a very important concept that is the economic order quantity, EOQ. That's a very important concept, right? And we can basically, all the costs that we've been talking about, let's now make sure that we group them, and we can group them into three groups of costs that are associated with inventory, right? So those will be the ordering inventory. Remember, we touched the ordering. I'm coming back again on that. So the ordering, now you sort of understand the ordering, and the carrying or holding inventory, right? So not only ordering, but holding that inventory. So that probably you can figure it out already that it would have to be with storage, right? The storage. Remember the inventory cost. There's acquisition. That would basically be the ordering cost. There is the storage part. Do you see the storage part? So the storage part would be the holding, right? The holding or carrying. And then you will have basically the cost of not carrying sufficient inventory. Very important. This is not just for decoration purposes. The third one that is added. It's very important. It has to do with the administration of cost. You need to know, do we have enough stock? When are we going to run out of stock? Because of what? Because we fear, for example, the stock out cost, right? We fear damage to reputation. We fear losing profit, losing sales, right? So this now brings the administration element, right? Quality cost brings the administration element, all right? So I hope now you are clear that this is very important for you to understand, right? All right. So the big term will be what is the right inventory level. What will be the right inventory level that we need to have? And that's basically the economic order quantity concept. We need to find what will be the right inventory level. And that right inventory level, how do we know it's right? Because it needs to minimize something. It needs to minimize cost. And in this case, it needs to minimize the ordering cost and the holding cost. It needs to balance these two big costs, the ordering as well as the holding. I trust that's quite clear, right? So this EOQ model is used to calculate the amount of stock a company should order to meet demand, while at the same time, right? At the same time, while minimizing the ordering and the holding cost involved, right? So I've put this balance here. So the EOQ, as usual with any economic principle, you will need to look at a balancing act somehow, right? So you need to balance the ordering cost and the holding cost. Now, I hope I'm doing very, very well because I hope you are understanding what I'm talking about here. All right. So now we are going to go into a bit of formula, but before we get there, let's talk about some of, I know I've put quite a lot of writing. I'm just trying to draw your attention when you're reading your textbook. I'm just trying to draw your attention on some important thing. Remember that this is the EOQ is a economic model, right? So with a model, obviously, a model is not reality. It's not perfect, but it has some assumptions. And some of these assumptions, and I can see actually in your exam, you being asked a question like this. For example, to say, what is involved into the EOQ model? They would say maybe the demand should be constant, right? So in the EOQ model, there are a few assumptions that we need to have. And that will be, for example, we need to make sure that we understand that the demand for the EOQ, it is assumed that the demand is known in advance, right? So we know the demand. You can't apply the EOQ when you don't know the demand of a company. And you cannot be asked a question about a company with regard to the EOQ without them telling you what's the requirements, what's the demand, basically. They can't give you an EOQ question without that, right? So we need to know, for example, that the ordering cost is assumed to be constant, right? So we're not going to deal with variable ordering cost. For the EOQ, you will all, so when you're writing a question on the EOQ, you should assume that the the ordering cost will be constant. The purchasing cost is also assumed to be the cost per unit, right? Is assumed, sorry, to be constant. So the purchasing cost or the cost per unit is constant as well. You need to assume that. You need also to assume that the delivery time is also constant. So if they say the delivery time is 100 days, right? When you order, it's going to take 100 days for you to receive your order. So basically, you know that order will not be, a variable order going up and down, changing, right? And the replenishment of inventory, this model implies that there is no delay when inventory is replenished. So there's no delay. But we know in real life, this is not the case. But for the EOQ, remember, this is a model. This is an economic model, right? But what you need to understand, let me come back again on the two main principle, is that we need to understand that the EOQ, it's about calculating the right amount, right? So the right inventory level. We are calculating the right inventory level or the amount of stock a company should order to meet the demand. So how much, remember we had two questions at the beginning. We want to find how much to how many what is the quantity to order, how much to order, and when to order it, right? Remember those two things, very important, logical, right? So now the it's so the EOQ will deal with how much to order, what is the quantity that we need to order, what is the right quantity that we need to order to meet the demand, at the same time while minimizing the ordering and the holding cost. Remember this balancing act. You need to balance the ordering and the holding cost, right? So I've taken a concept that sometimes students struggle with, and I've tried to make it as clear as possible. It's just few concepts that you need to understand there, right? So now enough talks. Let's now move into an example, right? An example will help us understand much better, right? So we have your example 5.3, which I would ask also to do by yourself, but Colors Galore buys a standard type of acrylic paint called Supreme Star Acrylic in 50-liter containers. So the containers are 50-liter containers at a price of 800 per container. So when you're looking at the price, this is not a cost. Price is 800 rand per container, right? And 19,200 of these containers. So these containers, these 50-liter containers, right? We need 19,200. So requirement, our requirement, and in this case, our annual requirement, what we need for our business, right? The total requirement that we need is 19,200 per year. So our annual requirement is 19,200. Now it's up to the company how they're going to order these 19,000. They can decide to say, we are going to do one order, and that one order, it will be a one order of everything that we need for the year, 19,200, right? They can decide to do that. Or they can say, okay, you know what? We're going to do multiple orders. We're going to do maybe 24 orders, or we're going to do 12 orders, or we're going to do 10 orders. You see, it does not matter. This depend on the dynamics of the company, right? But this is a good point for you to picture already when you're reading a question to understand what is happening. The stock controller estimate, right? So there is a stock controller, and that stock controller estimates that the cost of placing and receiving a typical Supreme Star acrylic order. So to order one container, it's going to cost 450. So the ordering cost is 450. So number one here is the price. I've tried to put, sorry that I didn't put it in, it's not very clean, but I want to show you that number one, when you are reading, take notes. I can scribble quickly on my paper or exam paper to say, number one is the price per container. The price is 800 Rand, and we know that. The second thing is the annual requirement. The annual requirement is 19,200 containers. You can scribble that on your paper, right? To say, okay, so I understand that. The third thing that they have given me now is the ordering cost. And they're telling me that the ordering cost to order a container, right, of the raw material is 450. So now I know, right? The fourth thing that they're giving me in this question, in this example, they're saying that the controllers estimate of the annual cost of carrying. Oh, so they gave me the ordering cost. Now they're giving me the carrying cost, and they're saying it's 6 Rand per container. You can see there it's 6 Rand per container. And what is that? The carrying cost is the holding cost. So you have ordering on one side, you have holding on the other side. You have ordering on one side, you have holding on the other side, right? Makes much sense. So they say now that suppose that Hanagalore were to order 800 containers of Supreme acrylic per order. So they decide, okay, we're going to order 800. Okay, so each order we are going to do 800. So we're going to divide then the total requirement. Our total requirement is 19,200 divided by 800. So if you do that, you will get 24 orders. So the company decided that it would be best to do 24 orders, to order in batches of 20, of 800, so that we can do 24 orders for the year. So at different period of the year, we need to make 24 orders to cover all the requirement that we have. Maybe because the production requires that, right? Maybe we do 24 cycles of production, right? 24. So we need also to have 24 orders. Like I said, it depends on the dynamic. Now you are being asked something very specific. You need to find what will be the economic order quantity. So we know, for example, can we calculate the annual ordering cost? We know what the ordering cost is, 450. So to order, so for ordering, one batch of 800, we will spend 450 Rand. You remember that, right? So that's the ordering cost. How many orders do we have? 24. 24 times 450 gives us what? 10,800, right? So that will be basically the annual ordering cost, 10,800. Now for the carrying, do you remember the carrying on the other side? There's 6 Rand. 6 Rand per container. All right. So what is for our formula to work, for the EOQ formula to work, we need to find the average quantity in inventory. So we will take the quantity per order. How many? So for every time we order, how many do we order? 800. What is the average? 800 divided by 2. What is the average? 400 containers. So 400 containers is an average, right? So it's the average quantity in inventory, right? So the annual holding costs is going to be, you take the average quantity in inventory, which we just calculated, of 400, multiply by the 6 Rand. So 6 Rand, this 6 Rand actually, we should call it 6 Rand for an average, right? For an average quantity, right? For an average quantity, because you take, and why, then you would tell me, why are we doing this? We are trying to find the holding cost for the year. Remember, we need to balance. We found the ordering cost for the year, number of orders multiplied by the cost per order. 24 orders multiplied by 450. Now, when it comes to the annual holding cost, we need to take an average quantity in inventory, which will be, every time we do an order, it's 800 containers we are ordering, divided that by 2, 400, multiplied by 6, will give us for the full year. So the annual holding cost is 2,400. Then we can find basically the total annual cost of inventory. What is the total annual cost of inventory? Ordering cost plus holding cost. Ordering cost plus holding cost. Ordering cost plus holding cost. I've repeated enough, and I trust that we are clear, right? So you take the 10,800 800 plus the 2,400, 13,200. There you have it. So please note that the 13,200 cost does not include the purchase cost, right? Here we are talking only about ordering and holding cost, right? So the question now arises as to whether Kalagalore can reduce the total cost, this cost that we have for the full year. for holding and ordering. Can we reduce it? Can we tweak how many times we order perhaps, right? Remember, because this one we are doing 24 orders. So they've provided, this is a beautiful thing, for example, to look at the order size, different number of orders, and then we can calculate the total annual cost. So you can see with 24, like we've done now, with 24, right? The ordering cost is 10,800, and the total annual we calculated just now is 13,200. But what if, for example, the order size was bigger, right? Instead of ordering 800, can we order more? Or like I was saying at the beginning, can we just do one order of 19,200? So you can either do one order of everything or divide, basically the total requirement, but on, maybe by 24, 20, 16, 12, 8, and all that, right? So what are we trying to do? We are trying to find out where would be the place where we have the lowest total cost. So you can play this game, but you can understand that you're going to need to do a lot of calculations. But we have a formula. And that's the purpose. Basically, I have managed to prove to you the reason why we use the EOQ. Because the EOQ gives us this formula. You can see the formula there. Instead of doing all these calculations in this table, so that we can find that, around an order size of 1,600, around this, we will have the lowest total annual cost. Instead of doing a big table like this, we can just use this formula, and this formula will lead us straight. All right. So what is in this formula? So let me move forward and just touch on what is in this formula before we move to the second part of our session, right? So EOQ, it will be the square root. This is a square root. And what we have inside is 2. 2 is a constant, right? D is the annual demand or requirement. What is our annual requirement? Our annual requirement is 19,200. So it's the demand. So the company, we need 19,200 for the year. So that's the annual requirement. Okay? So what is O? O is the cost per order. O is the cost per order, right? Remember the cost per order, or the ordering cost? Ordering cost. The ordering cost was provided to us. It's here. We have it here. Number 3 here, ordering cost is 450. 450. So now the denominator will be H. You're going to take H. What is H? H represents annual holding cost per unit. What is the annual holding cost per unit? Do you remember it? Come on. It's 6, right? So you take 6, you put it there. And then there is plus, you open the bracket, there is a P. P stands for the cost price per unit, the cost price. And we know the cost price per unit. Remember the cost price per unit? It was 800, right? The problem here, it's not really a problem. The formula provide also for an interest. Now, if you are not provided that interest, it's called, it is only used, basically this in parentheses will only be used only when the inventory is financed through an interest-bearing debt. So if the inventory is financed by debt, if you're using debt to finance inventory, you need to put the interest. But if there is no interest, right, it's not an interest financed debt, right? An interest bearing debt that you are using to finance, basically you need to skip this. So whatever is in the parenthesis will be basically 0, or, so H plus 0 equals H. So I hope you understand. If they give you an interest, use the interest. So you will multiply the price times the interest. So if there is a 20% interest, you will take the price of 800 multiplied by 0.2, right? You will do that. But if there is no interest, basically that will be interest is 0, price multiplied by 0 equals 0. So you will only be left with one thing, H. So the denominator will only be H. I hope I make this clear. But what this provides us is a quick way to know exactly what is the correct balance. So the correct balance here, the correct balance here between ordering cost and holding cost will be 19,697.06. Obviously, we're going to ignore the dot 06. We're going to round. We have to round up because we don't have half of a unit, right? We're going to round up. So to be exact, it's going to be 1,698. Guys, there you have it. So you don't need to do this big table to find where does it balance. And when you can see here, you can see that it's like a curve, a curve. And the lowest was this 10,200. That was the lowest point, meaning that's where we get the lowest cost. This makes sense because the 16,000 with the ordering quantity, we can even get much better. We can even get actually a more precise answer. So it's 16, it's it's 1698 or 1698 to be precise. Make sense? All right, so you're gonna do the other exercise and try to exercise to get a good grasp. So, but now the question of when. Remember, we tackled the question of how much to order. Now we need to tackle the question of when to do it. And that's where basically the concept of reordering point. When in your company do you reorder? Huh? When do you reorder? And what is the meaning of safety stock? Safety stock. What is that, right? So the central idea is to minimize the cost of holding inventory. Because when you are talking about reordering point, is that you want to minimize the inventory, to minimize the cost of holding the inventory while ensuring that there will be no stockouts, right? You don't want to run out of inventory, but you don't want also to have too much, which is going to cost you more to hold. Do you get it? So we need to have, in order for us to balance it properly, we need to have a reorder point so that we are minimizing the cost of holding inventory for nothing, right? We need just to ensure that there is sufficient inventory. The purpose of you as an entrepreneur or as a manager, you don't want to waste money. You don't want to waste money, right? But you want to make sure that there is sufficient inventory on hand to satisfy the production requirement, or the customer demand. You just want to make sure. So you don't want to have too much. You don't want to have too little. Does it make sense? Very, very, very much, right? So to prevent this, we need to establish a reorder point that will indicate the level of inventory at which, okay, an order should be initiated. So we're saying, okay, we have this amount. If the inventory drops to a certain point, we need to initiate the reorder, all right, to replenish the stock. Because remember, you are using the stock, therefore the stock is depleting, is going down. But how down do you need to get before you replenish, before you order again, so that you can fill back again the stock, right? Wonderful. So remember, there is important concept that you need to do to understand. It's the EOQ, obviously. EOQ, what does it stand for? Economic order quantity, which we just calculated. So we need to know what is the EOQ, all right? Any exercise we are given, we need to understand when they ask us, can you find for us the reorder point? We need to have the EOQ. We need to have the lead time. Now, what is the lead time? The lead time, it's a period of time between when an order is placed. So if I place an order today, how long is it going to take lead time to the order arriving and being received? You understand? So here it is. I've provided you with a picture so that you can understand. So there is a lead time there. When I place an order, how long is it going to take? Is it going to take 4 weeks for the order to arrive, right? Okay. And the last concept is the usage rate. Now, there are two things you need to understand about the usage rate. So during that time, during the lead time, when we are waiting for an order to come, how are we using what we have? How do we have a constant, steady usage of inventory? Or do we have a variable? Or do we use differently? Like 1 month we use 30, the other month we use 10. You see, because sometimes it can depend on the demand. Company can legitimately have a particular demand fluctuation. Maybe the demand is not constant. Maybe some months they order more, some months they order less, right? So all these can impact, right? So let's talk about when the usage during the lead time is constant. So when we reorder something, when we place an order, and we have a constant usage, all right? This will be the formula you're going to use. A very simple formula. You're going to multiply the lead time. Let's say it takes you 4 weeks. You're going to multiply it by the daily or weekly usage. So you need to know if it's daily usage or weekly usage, right? Okay. Or, you know, it has to do with a time period. So to illustrate this, let's use this example. There is this company that has, sorry, a EOQ of 100 units. So the company has an EOQ. So the requirement of the company, remember we talked about the requirement, but we talked about the exact quantity that they need that minimizes ordering and holding costs and also meets the demand of the company. You remember that? That's the EOQ. So to be honest, the right amount that they need is 100 units, and we are happy for them, right? So the lead time is 4 weeks. They tell us the lead time is 4 weeks. That's interesting. So we have 4 weeks, when we place an order. And I have put it here for you to understand. You have everything in your notes. So they have a lead time of 4 weeks. They have an EOQ of 100 units, right? So we know that when they replenish, they have 100 units, they're gonna start using those units. At which point do they need to reorder? That's the question that is being asked of you. How do you find that? You need to take the lead time. The reorder point, you're gonna take the lead time, which is 4 weeks, right? 4 weeks plus the weekly usage. And they told you here that in the question, they said the average weekly usage, the average weekly usage is 20 units. So you're going to take 20 units, multiply by 4, which is going to give you 80. So when we have a full house, when we have ordered, we have 100 units, we're going to start using those units. When we get to 80, we need to reorder, right? Because it's going to take exactly 4 weeks before we get to zero. By the time that we get to zero, we would have already received another 100 units. I hope that makes sense. But did you notice something? Here, the average is constant. The average is constant. So meaning we are using a 20 units per week. But what if the it's not constant, it is variable? What if the usage during the lead time is is a variable usage, right? What if the usage fluctuates, goes up and down? That's the reason why we have a dimension two when we have a variable usage during the lead time. For example, in week one, we might be using 30 units. In week two, we might be using 10 units. In week three, we might be using 15 units. In week four, we might be using 25 units. Obviously, in this case, you need something that you need a buffer that we call a safety stock. Safety stock is more like an insurance policy. It is there to, to as a security against greater than usual demand or against any problems that we might experience in the ordering or delivering of product. The safety stock is very important, right? And remember again, we don't run out of. You as an entrepreneur should know that that's a no, no, no. That's not good business. Stock out is not a good business, right? Okay. So in this case, for example, when we have a fluctuation, remember in our initial example, they gave us an average of 20 units per week, but they said that the maximum expected usage for a week is 38 units. 38 units. So meaning it could be higher, right? 38, more than 20. So how are we going to do? Like in this case, how did we calculate, by the way, the average? The average, obviously, we added week 1, 30, week 2, 10, which is 40, week 3 and week 4, which is 80. So 80, for us to get an average, we say 80 divided by 4 weeks gives us 20. That's how we got the average, right? But with this average, because there is fluctuation, because it goes up and down, we need a safety stock. How do we calculate the safety stock? Calculate the safety stock, you're going to take the maximum expected usage per week, which is 38, minus the average usage per week, right? So the average usage per week is 20. So 38 is way above 20, which is about 18 units in excess. So you're going to take that 18 unit in excess. Let's say, for example, all the 4 weeks we have 18 unit in excess. So we will need a safety stock of 18 units times 4, because times 4 weeks. So the total safety stock will be 72 units. Sorry, that I say always safety, but safety, right? By habit, I tend to say safety, but it's safety, right? So safety of 72 units. All right. So now, if you have a safety of 72 units, now do the math with me, right? So you have 100 units for the EOQ. So the right quantity that you need is 100, but you need a safety of 72 units. 100 plus 72 gives you what? 172. 172 units, right? So already week one. So look at the usage at week one. Let's say in reality, this is now real. It's happening in this company. Week one, 30 units. Obviously, from 172 minus 30 will give you 142, right? So at the end of week one already, you would have 142. So, but when is the reordering point? When you have variable or fluctuating usage. When you have fluctuating usage, you are the reorder point is simple. You take the lead time times the weekly or daily usage, just like we did here for the constant. The only thing you're going to do is to add the safety, plus safety. So you're going to take this formula for the constant plus the safety. And we know the safety is 72. So the total, what will be the total? Remember that here, the reorder point when it's constant is 80. 80 plus 72 gives you 152. So that's the reordering point. You will see already that before week ends, before the first week ends, you need already to reorder. Because at the end of week one, you will be at 142. 142, which is already, because the reorder, which is 10 units below the reorder point. So during the week one, you need already to reorder, okay? Because you might run out of stock, right? Remember, the lead time is still 4 weeks. The lead time is not changing. It's 4 weeks, right? Lead time is 4 weeks times 20 plus 72, which is 152 unit. So when the usage is variable usage during lead time, you need to use this formula because you need to calculate the safety stock. All right. So I trust that this is clear. We have covered it. Actually, we're not going to come back on this. We have covered it thoroughly. And part 3 is already available to you in your in the pathway that I've provided to you. Please use these exercises. So the last part is the apportionment of overheads, right? So the apportionment of overhead is very important, and there are 3 methods that you need to worry about, right? You have the direct method, the step method, and the linear algebraic method. So all these 3 are properly covered in part 3 that I've already provided to you. Please use the lecture video as well as the material and the notes that I've provided to you cover these things, and they have covered properly and in detail, especially the direct method. It's thoroughly covered, as well as the step method properly covered, right? So you have absolutely everything at your disposal to understand the part 3. Right. So, ladies and gents, so that was our part 2, the middle section of Learning Unit 5. We've taken a bit of time, but it's important to really cover it properly so that when you are in the exam, you don't need, like I told you at the beginning, you do not need to memorize a formula. It's not needed, because what could happen is that you might forget the formula, or you might apply the formula wrongly, right? So understanding the formula, understanding why the formula is used, and all the elements of the formula is the way to go to do well in your exam. All right. And that basically was the reason for taking this time to really cover each concept. But it is now your role as a student to go deeper as you are studying. Please go deeper, and should there be any concept on what we covered while you are reading, while you are taking, also you are making your own notes for your exam prep, should you come across something that doesn't make sense and you need more clarity, please submit your question to the entire class so that we can, for purpose of practice, right? For the entire class as well as for yourself, right? So I trust you will do well, and